The US Federal Reserve raised interest rates by 25 basis points to 5%, but it indicated that it will pause further hikes in the borrowing costs. After 8 successive rate hikes in the past year, investors hope that the Fed will keep the rates unchanged this time around due to the ongoing banking crisis in the US. But the Fed raised interest rates once again, focusing to bring down inflation instead.
This rate hike was more or less in line with market expectation. A few weeks back, the Fed chairman Jerome Powell had said that aggressive rate hikes will continue if data supports. This had kept the hopes alive for another 50 basis point rate hike. However, the Silicon Valley Bank collapse has turned the table around.
After the sudden failures of the Silicon Valley Bank and the Signature Bank, the Fed's latest policy statement no longer says that an ongoing increase in rates will likely be appropriate.
There are chances for the Fed to pause going forward. Their forecasts show that the Fed fund rate will be at 5.1% for 2023. This leaves room only for another 25 basis point rate hike from here. So, if the Fed increases the rate again in May, then it can pause for the rest of the year. However, this will be valid only if the projection doesn't change going forward.
Will we see a rate cut this year? Well, no, according to Jerome Powell, the chairman of the Federal Reserve. Also, the Federal Open Market Committee policy stated that the US banking system is quote sound and resilient. What does the Fed action mean for the US dollar and what impact will it have on the rupee?
As an initial impact, the dollar index has weakened after the Fed meeting outcome. This is because the treasury yields have come down after the Fed meeting. On the charts, the US yields can still come down from here, so this can keep the dollar weak. The weakness in the dollar index will be positive for the Indian rupee. On the charts, the outlook is positive for the rupee. The rupee can break 82 and strengthen to 81 in the short term.